The date is August 12th, 1982. On the upper floors of a glass tower in New York City, a small group of men sit around an immaculate conference table, the skyline reflected on its polished surface. Telephone speakers crackle softly. Notepads lie open, untouched. Coffee cools in porcelain cups. No one is drinking. The atmosphere feels less like a business meeting and more like the quiet before a verdict. On the line is Mexico's finance minister. His voice is restrained, professional, but every person in the room understands that what he is about to say could tear through the global financial system. Mexico, he explains, can no longer meet its debt obligations. The country is out of dollars. The interest payments alone are suffocating its economy. Mexico, one of the largest borrowers in the developing world, is effectively insolvent. For a few seconds, there is only silence, not because the executives from the world's largest banks do not understand, but because they understand too well. These are not isolated loans to a single struggling country. The balance sheets in front of them show something far more dangerous. Mexico's debts sit alongside those of Brazil, Argentina, Chile, the Philippines, and dozens of others, all tied to the same cluster of institutions, the same currency, the same rising interest rates. What is collapsing in that moment is not just Mexico's ability to pay, it is the credibility of an entire model of global finance. Over the previous decade, these banks had lent hundreds of billions of dollars to governments across the global south. They had done it with startling confidence, often with minimal scrutiny, convinced that sovereign states do not default. Debt, they believed, was merely a bridge to development, safe, profitable, and self-reinforcing. Now, in a few words from a distant capital, that illusion is shattering. In public, this crisis would be framed as a story of reckless borrowers. Headlines would talk about overspending, corruption, and mismanagement. Commentators would lecture entire continents on the dangers of living beyond their means. But the men in that New York boardroom know another story, one that is far less convenient. They know how aggressively their institutions pursued these loans, how they recycled the flood of oil money sitting in their vaults into high-interest credits abroad, how they moved in near lockstep offering similar terms, chasing the same states, assuring each other that the risks were manageable. They also know something else. If Mexico falls and the contagion spreads, it is not just faraway governments that will be in danger. The banks themselves could be pulled under. The supposed guardians of global finance are suddenly exposed as some of its most vulnerable players. This is the moment the world notices the fire, but the fuse was lit years earlier. To understand how the first modern global debt crisis erupted, it is necessary to step back to the early 1970s, to the collapse of the Bretton Woods system, to the oil shocks, and to the silent rise of an informal alliance that behaved in practice like a cartel. It did not issue public manifestos or sign official charters. It did not need to. Its power came from alignment, not ceremony. Major commercial banks in New York and London, Western governments, oil exporting states awash in cash, and international institutions that dictated the rules of economic orthodoxy. This network did not announce itself to the world as an organized bloc. It operated through meetings behind closed doors, through market consensus, through shared assumptions and shared interests. It funneled surplus petrodollars into the balance sheets of developing nations, stacking loan upon loan, embedding variable interest rates and dollar-denominated obligations into contracts that would later become financial time bombs. The rhetoric was about growth, modernization, and integration into the global economy. The reality was a web of dependency that left dozens of states dangerously exposed to decisions taken in a handful of financial centers. By the summer of 1982, the trap has already snapped shut. The United States, in its war against domestic inflation, has driven interest rates to levels unseen in modern history. Payments on floating rate loans have soared, commodity prices have stumbled, export earnings in much of the developing world have sagged. Countries that once appeared as promising emerging markets have become, almost overnight, high-risk debtors struggling to stay afloat. Yet when the pressure began to build, there was no coordinated move by the banks to restructure early, no serious retreat from risk while there was still time to exit gracefully. Instead, the lending continued, often just to keep previous loans from appearing as losses. This is not the behavior of cautious, independent institutions, each weighing risk and reward in isolation. It is the behavior of actors locked into a shared strategy, each one afraid to be the first to recognize the truth. Together, they extended credit far beyond what was sustainable, and together, they pushed the system to its breaking point. In the days and weeks after Mexico's announcement, the same glass towers host a new round of emergency meetings. Treasury officials, central bankers, and representatives from the International Monetary Fund arrive with thick folders and prepared talking points. The narrative begins to shift in real time. The crisis will be treated not as the failure of a lending frenzy, but as a temporary liquidity problem on the part of debtor nations. Rescue packages will be discussed. Conditions will be imposed. Balance sheets will be protected. The human cost in countries forced into brutal austerity will be considered a regrettable but necessary adjustment. The public will be told that the system is being saved. What will rarely be admitted is that the system being saved is the same one that engineered the crisis in the first place. The cartel that formed to profit from the flow of petrodollars will reconstitute itself as the authority that manages the fallout, dictating terms to those now trapped in its web. The same institutions that pushed easy credit will now demand sacrifice, discipline, and obedience. The story that follows is not a conspiracy in the theatrical sense, with secret oaths and hidden layers. It is something more unsettling, a convergence of incentives, institutions, and ideologies that transformed global debt into a mechanism of control. The first global debt crisis did not simply happen. It was constructed through decisions made in central banks, corporate boardrooms, and international organizations that viewed entire nations as entries on a ledger. This is the story of the unknown cartel that orchestrated the first global debt crisis, how it emerged from the rubble of the post-war order, how it weaponized surplus capital, how it locked the developing world into a devastating cycle of dependence, and how, when the system finally buckled, it rewrote the narrative to conceal its own role. The telephone lines in that New York tower eventually go silent. The coffee cups are cleared away. The executives return to their offices, already thinking in terms of negotiations, guarantees, and political pressure. Outside, the city continues its restless movement, unaware that, in a single conversation, the financial fate of millions has shifted. In Mexico City, in São Paulo, in Buenos Aires, in Lagos, the consequences will not be abstract. They will be measured in shuttered factories, empty hospital wards, and generations growing up under the shadow of a crisis they did not cause. The global system will present this as an unfortunate chapter, a painful but necessary correction. Yet beneath the official communiques and the economic jargon, a clearer pattern emerges. When credit becomes the lifeblood of nations, those who control its flow hold more than money. They hold the power to shape destinies, and in the final decades of the 20th century, that power lay not in the hands of elected governments or global publics, but in an unelected network that behaved, in every critical moment, like a cartel. In the years leading up to that phone call from Mexico, the world had been quietly rearranged. After the Second World War, the victors built a financial order meant to be predictable, almost mechanical in its stability. Currencies were pegged to the US dollar, and the dollar itself was tied to gold at a fixed rate. In theory, this system, Bretton Woods, would prevent the kind of uncontrolled collapses that had helped fuel the rise of extremism in the 1930s. The International Monetary Fund and the World Bank were created as guardians of that order, promising support for countries in trouble and capital for those seeking development. It was a world of fixed rates, careful adjustments, and tightly controlled capital flows. For a time, it worked. Trade expanded, reconstruction accelerated, and the dollar became the unquestioned anchor of the global system. But beneath the surface, pressures were building. The United States began to run persistent deficits, spending heavily on both domestic programs and foreign wars. Dollars poured out across the world in quantities that no longer matched the gold reserves supposedly backing them. Other nations grew uneasy. Some quietly began to demand gold instead of paper, testing the credibility of the system. By the late 1960s, it was clear to anyone close to the machinery that something would have to give. On August 15, 1971, it did. In a televised address, President Richard Nixon announced that the United States would suspend the dollar's convertibility into gold. In technical terms, it sounded like a temporary measure. In reality, it was the end of Bretton Woods. The dollar would now float. So would other major currencies. The world had moved from a fixed, rule-bound system to one that was more flexible, more volatile, and more open to financial experimentation. Where there is volatility, there is profit for those who know how to navigate it. And in the new world of floating exchange rates and liberalizing capital markets, the institutions best positioned to do that were large commercial banks. They had the expertise, the connections, and, soon, the money. That money arrived in a surge during the 1970s, carried by the sudden rise of a new force in the global economy, the oil-exporting states. In 1973, as geopolitical tensions erupted in the Middle East, major oil producers coordinated to raise prices sharply. Overnight, the cost of energy multiplied. For oil-importing nations, it was a shock that ripped through budgets, trade balances, and inflation rates. For the members of OPEC, it was a windfall. Hundreds of billions of dollars began accumulating in their accounts, far more than they could spend or invest domestically in the short term. Those dollars did not sit idle for long. They flowed into the balance sheets of major banks in New York, London, and a handful of other financial centers. These banks suddenly found themselves custodian of vast petrodollar deposits. It was an opportunity, but also a problem. Idle deposits generate no profit. To turn these balances into returns, the banks needed borrowers, and they needed them fast. At home, in the developed economies, credit demand was limited and heavily regulated. Interest rate caps, prudent oversight, and the legacy of the Great Depression still constrained how aggressively banks could push leverage. But beyond the industrialized core, there lay a world of governments hungry for capital, nations in Latin America, Africa, the Middle East, and Asia eager to build roads, factories, power plants, and modern cities. Many had recently emerged from colonial rule. Their leaders spoke the language of development, modernization, and national progress. To the banks, they looked like the perfect clients. This is where the outlines of the cartel begin to take shape, not through a secret meeting, but through a convergence of needs. Oil exporters needed a safe place to park their surpluses. Western banks needed profitable outlets for those funds. Developing countries needed capital to fuel ambitious growth plans. Each actor saw gain in the arrangement, but the terms of that arrangement would be written not in neutral language, but in contracts that tilted the balance of power in one direction. Loans were rarely simple bilateral agreements. Instead, they were syndicated, bundled together by a lead bank, and then shared among a group of large institutions. This meant that when a government entered into a borrowing agreement, it was binding itself not to one lender, but to a network. Meetings in financial hubs brought together representatives from multiple banks who agreed, formally or informally, on pricing, on maturities, on the basic structure of the deals. They spoke of diversification and risk sharing. In practice, they were standardizing the terms under which much of the developing world would access credit. The numbers looked persuasive. When commodity prices were high and global growth was strong, the cost of servicing these loans appeared manageable. The contracts often carried variable interest rates, tied to benchmarks like the London Interbank offered rate. As long as those benchmarks remained low and stable, the burden of repayment seemed modest. Governments could borrow, build, and show progress. The banks could report soaring profits from interest income, fees, and the prestige of being central players in global development. But embedded in these deals were subtle asymmetries. The loans were denominated in dollars or other major currencies, not in the borrower's own money. That meant any change in exchange rates or global interest rates would fall squarely on the debtor AS shoulders. The risks of inflation, monetary tightening, or currency swings in the advanced economies were effectively exported to the developing world. The contracts said nothing about fairness. They simply reflected the leverage of those who drafted them. International institutions gave the arrangement an air of legitimacy. Reports from technocrats framed the borrowing as a rational strategy for catching up. Conferences and policy papers described the recycling of petrodollars as a sophisticated mechanism that would stabilize the global system. The language was dense, technical, and reassuring. It portrayed the architecture as neutral, almost scientific. Behind that language stood a reality that was far more political, a nexus of interests in which Western financial stability and bank profitability took precedence over the long-term resilience of debtor nations. Inside the banks, risk models and internal memos created a sense of comfort. Sovereign states, unlike corporations or individuals, were presumed to be extremely unlikely to default. They had taxation powers, assets, and political incentives to honor their obligations. A failure by one might be conceivable. A cascade across multiple countries seemed improbable. This belief, repeated often enough, hardened into dogma. It justified ever larger exposures. By the late 1970s, the numbers had grown staggering. Countries that only a few years earlier had modest external debts now carried obligations in the tens of billions of dollars. Their budgets were increasingly shaped not by domestic priorities, but by the timetable and structure of foreign repayments. Yet in financial capitals, the mood remained complacent, even confident. The flow of oil money continued. The loans kept rolling. Spreads and fees piled up. There were warnings. A handful of economists and officials pointed out the vulnerability created by variable rate loans and rising global imbalances. They noted that the system depended on a fragile assumption that the cost of borrowing would remain low, and that global demand for commodities from the developing world would stay strong. If either of those conditions faltered, the ability of debtor nations to pay would be thrown into question. Those warnings drifted across desks, filed alongside countless other reports. For many decision makers, the incentives pulled in another direction. As long as the loans continued, quarterly earnings looked impressive. As long as everyone kept lending, no single bank appeared overly exposed compared to its peers. The alignment of interests was not explicit, but it was powerful. Together, the major banks formed a kind of gravitational field, drawing more and more countries into the same orbit of indebtedness. It is in this sense that the term cartel becomes useful, not as a legal classification, but as a description of behavior. In sector after sector and country after country, a relatively small circle of institutions promoted the same strategy, underwritten by the same beliefs, and defended by the same narrative of progress. There were differences in detail, in pricing, in specific deals, but the larger pattern was remarkably consistent. Credit would flow outward, profits would flow back, and the risks, structural, long-term, and systemic, would be treated as abstractions. In the capitals of the borrowing nations, the immediate picture looked different. New highways opened, ports expanded, state-owned enterprises multiplied. Technocrats spoke with confidence about joining the ranks of the developed world. For political leaders, access to foreign credit offered a way to fund ambitious projects without raising taxes too sharply at home. It also provided leverage within domestic power struggles. Debt, in this context, was not just an economic instrument, it was a tool of statecraft. Yet every new loan carried a quiet condition that future governments and future generations would bear the burden of repayment. As external debt grew, so did the dependence on continued goodwill from the same cluster of banks and institutions. A government that fell out of favor with major creditors could find its access to capital abruptly constrained. Policies deemed unorthodox or irresponsible by international standards risked being punished, not by formal sanctions, but by the withdrawal of credit and the rise of borrowing costs. Through the 1970s, this architecture tightened. The petrodollar cycle turned surplus from oil sales into leverage over indebted states. The banks, with their syndicates and standardized contracts, became the conduits. The IMF and other organizations stood ready as managers of last resort, prepared to step in if a country struggled, but always with conditions attached. Each component played its role. Each benefited from the continuation of the system. What almost no one admitted publicly was how exposed that system had become to a single lever: the price of money set in Washington. When the U.S. Federal Reserve, under Paul Volcker, decided to launch an uncompromising assault on inflation at the end of the 1970s, it did so with the domestic economy in mind. Interest rates were driven upward to levels not seen in decades. Credit inside the United States became painfully expensive. The move was hailed by some as an act of necessary discipline. For the indebted nations of the developing world, it was something else entirely. Overnight, their borrowing costs exploded. Because so many of their loans had been written with floating rates pegged to benchmarks influenced by U.S. policy, a decision taken in one country's central bank rippled outward as a shockwave. The same contracts that had seemed manageable now became instruments of pressure. What had been sold as a bridge to prosperity began to resemble a tightening noose. The unknown cartel had never needed to announce itself. Its existence was encoded in the way decisions aligned, in how risk was shifted, in how stories were told about what was sound and what was reckless. As the 1980s dawned, the system it had built was approaching a point of no return. The debts were too large, the rates too high, the margins for error too thin. It was only a matter of time before one government, somewhere, would finally admit what many already knew in private. The numbers no longer added up. The first to say it out loud, in a way the world could not ignore, was Mexico. When the call came in 1982, it was not a philosophical argument or a technical memo. It was a blunt statement. The country could not meet its payments. For years, officials had rolled over loans, negotiated new lines of credit, and adjusted budgets to keep up appearances. But the arithmetic had become impossible. The dollars flowing out in interest and principal exceeded what could plausibly be earned through exports and growth. The buffer had evaporated. In the initial hours after Mexico's announcement, there was genuine fear inside the financial establishment. The exposure of major banks to sovereign debt in Latin America was so large that a wave of outright defaults could have triggered their own collapse. These were institutions embedded deep in the economies of the United States and Europe, linked through complex interbank markets, derivatives, and payment systems. If they failed, the damage would not stop at Wall Street or the City of London. It would spread into pensions, corporate financing, and the basic functioning of the global monetary system. The crisis was, therefore, not simply a matter of disciplining an overextended borrower. It was an existential threat to the core of the cartel itself. The same network that had encouraged the lending now had to confront the possibility that its own balance sheets would be revealed as fragile. In that sense, the early stage of the crisis was less about saving Mexico and more about saving the architecture through which global credit flowed. Behind closed doors, discussions moved quickly from panic to strategy. Officials from creditor governments, especially the United States, understood that allowing large banks to fail en masse was not an option they were willing to accept. Instead, they sought to transform the problem into something that could be managed, not a solvency crisis in the North, but a liquidity crisis in the South. The International Monetary Fund, designed decades earlier to help stabilize economies in trouble, now became the central instrument through which this transformation would be carried out. The logic was simple and ruthless. Debtor nations would not be allowed to walk away from their obligations. They would be kept current, or at least close enough, through emergency financing packages. Those packages, however, would not come without strings. The IMF would provide funds, but in return it would demand sweeping policy changes, cuts to public spending, devaluation of currencies, opening of markets, privatization of state enterprises, and the removal of barriers to foreign capital. The language used was one of adjustment, stabilization, and restoring confidence. Underneath that language lay a different imperative: to ensure that the service on existing debts continued, protecting the interests of the major creditor banks. In practical terms, this meant that the burden of the crisis would be shifted downward. Losses that might otherwise have appeared on the balance sheets of northern financial institutions were instead absorbed by debtor societies through unemployment, inflation, and reductions in public services. A default that might have forced a reckoning with the excesses of the lending boom was averted. The cartel structure remained intact. In the streets of the affected countries, there was no such abstraction. In Mexico, Brazil, Argentina, and beyond, the 1980s would come to be known as a lost decade. Economic growth stalled or reversed. Real wages fell. Investments in health, education, and infrastructure were scaled back under the pressure of austerity. The promises of rapid modernization, made only a few years earlier, began to look like illusions. For millions, the crisis was experienced not as a technical adjustment, but as a decline in living standards that stretched on for years. Yet, in communiques and press conferences, the narrative was carefully shaped. Officials emphasized the responsibility of debtor governments. They pointed to mismanagement, corruption, and inefficient state enterprises. They described the crisis as a necessary correction after a period of overreach. Almost never did they dwell on the role of the institutions that had flooded these countries with loans on terms that magnified their vulnerability. The idea that the creditor network had behaved like a cartel, coordinating its practices, standardizing its contracts, and pushing a shared model of development financed by foreign debt, was politely excluded from mainstream discussion. Instead, the same institutions recast themselves as the solution. The IMF and World Bank designed structural adjustment programs that would, in theory, place these economies on a sounder footing. Privatization would make industries more efficient. Trade liberalization would integrate them more fully into the global market. Fiscal restraint would control inflation and reassure investors. But the sequence in which these changes were introduced and the conditions under which they took place often favored the interests of foreign capital over domestic stability. Assets were sold off at distressed prices. Local industries struggled to compete against imports. social cohesion frayed under the strain of prolonged austerity. From the perspective of the cartel, however, the outcome had a certain logic. The debts remained on the books. Some were rescheduled, some restructured, but wholesale repudiation was avoided. Over time, new instruments would be introduced, such as Brady bonds, to transform old, non-performing loans into tradable securities, spreading the risk further across global markets. What might have been a reckoning with the entire model of debt-driven development instead became an opportunity to deepen financial integration on terms set by the same centers of power. In this process, the language of responsibility flowed in only one direction. Debtor countries were told to reform, to tighten, to sacrifice. Creditor institutions were not asked to confront the incentives that had driven them to such levels of exposure in the first place. No binding mechanisms were introduced to prevent a similar pattern from repeating. There was little serious talk of shared blame and even less of systemic change. The cartel had orchestrated the conditions of the crisis. Now it orchestrated the terms of recovery. The human dimension of these decisions rarely appeared in the official record. It existed instead in the crowded buses of cities where fuel prices had risen and wages had stagnated, in the wards of hospitals where budgets had been cut, in the classrooms where resources were scarce and teachers were underpaid. The arithmetic of adjustment, neat in spreadsheets and policy documents, translated into lives lived with less security, fewer opportunities, and a deeper sense of vulnerability to forces beyond local control. Every so often, social tension boiled over. Protests erupted against price hikes, layoffs, and perceived foreign interference. Governments fell, replaced either by new coalitions promising to soften the impact of austerity or by more repressive regimes determined to enforce it. In some countries, the crisis helped catalyze transitions away from military rule. In others, it reinforced the power of entrenched elites who could navigate the new order more effectively than the broader population. For the cartel, such turbulence was an acceptable side effect. What mattered was that debt contracts remained enforceable, that the principle of repayment stayed sacred, and that no precedent was set for widespread repudiation. With each successful stabilization program, the message was reinforced. Even when the system misallocates capital and amplifies vulnerabilities, the obligation of the debtor is to adjust, not to challenge the architecture itself. In time, the immediate panic of 1982 faded from memory in the financial centers. The banks recapitalized. Regulatory changes and quiet support from central banks helped them weather the storm. The petrodollar deluge of the 1970s evolved into new forms of global liquidity. Emerging markets returned to international capital markets under new conditions, borrowing not just from banks, but through bonds and other instruments purchased by a wider array of investors. The faces at the negotiation tables changed. The underlying pattern did not. What remained largely invisible to the wider public was how close the system had come to a very different outcome. Had multiple countries simply refused to pay? Had debtor governments coordinated as forcefully as their creditors, the balance of power might have shifted. The crisis might have become a moment of renegotiation over who bears responsibility for the risks embedded in cross-border lending. Instead, the asymmetry held. The cartel stayed aligned, and the debtor nations, fragmented and under pressure, accepted the terms. The first modern global debt crisis, then, was not only a story about the dangers of excessive borrowing. It was also a demonstration of how financial power operates when it is concentrated in a relatively small number of institutions and aligned with supportive states and international bodies. It showed that when the survival of that nexus is at stake, the response will be calibrated to protect its core, even if doing so inflicts deep and lasting damage on societies at the periphery. In public debate, the episode is often remembered in simplified form, a cautionary tale about countries that took on too much foreign debt and were forced into painful adjustments. That version of the story is not entirely false, but it is incomplete. It omits the way in which the structure of lending, the terms of contracts, and the behavior of creditors turned vulnerability into catastrophe. It overlooks how the cartel first amplified risk and then positioned itself as the indispensable manager of the resulting crisis. The unknown cartel did not disappear after the 1980s. It adapted. The names on the office doors changed as banks merged, failed, or rebranded. New financial centers rose alongside the old. The instruments through which debt was issued and traded became more complex, but the fundamental pattern of credit extending outward from a concentrated core, embedding peripheral economies in webs of obligation, and then being defended with all available tools when it threatened to snap, remained. The first global debt crisis was, in that sense, both a warning and a rehearsal. It revealed how a system organized around debt and protected by a cartel-like alliance of institutions would behave when its own decisions pushed it to the brink. It revealed who would be asked to pay, whose narratives would dominate, and whose role would be quietly edited out of the official history. In the years that followed, the echoes of that first modern global debt crisis could be heard in other corners of the world. The setting changed. Different currencies, different institutions, different acronyms, but the underlying choreography remained unsettlingly familiar. Credit would surge into a region encouraged by a narrative of opportunity and modernization. Risks would be downplayed, structured into contracts that transferred volatility to the borrower. When the cycle turned, the language of partnership would fade, replaced by the stern vocabulary of discipline, reform, and adjustment. For decades, many of these countries had been held up as success stories, combining export-led growth with careful state guidance. Foreign capital began flowing in at scale, attracted by high growth rates and the promise of rapid financial development. Local banks borrowed abroad, often in foreign currencies, to fuel domestic booms. Corporations followed suit, tapping international markets to expand aggressively. On the surface, it appeared as though these economies were integrating into a more open, more modern, global financial system. When confidence faltered in 1997, the reversals were swift and brutal. Currencies collapsed, stock markets plunged. Companies that had borrowed in dollars or yen suddenly found their debts multiplying overnight when measured in local money. The same global financial centers that had praised these miracles began to talk instead of crony capitalism and structural weaknesses. Governments were pushed to raise interest rates, slash spending, and open markets further, even as their economies were contracting. Critics argued that some of these measures deepened the recessions rather than alleviating them, turning financial crises into broader social traumas. It was encoded in shared frameworks, in the revolving doors between financial institutions and policy roles, in the instinctive alignment of those whose professional futures depended on the continuity of the existing order. When multiple actors with comparable interests respond to crises in similar ways, the effect can be indistinguishable from coordinated strategy. At the turn of the new century, another theater emerged, Europe itself. In the wake of the global financial crisis of 2008, vulnerabilities that had accumulated within the Eurozone were exposed. The creation of a common currency without a fully unified fiscal system had allowed capital to flow freely from core economies to the periphery. When the crisis hit, the liabilities on the books of those banks became a source of acute anxiety. A sovereign default in one Eurozone member state threatened not just local turmoil, but losses that could ricochet through the entire European banking system. The response that followed bore all the marks of the architecture refined since the 1980s. A combination of European institutions, national governments, and the IMF, dubbed the Troika, stepped in with support packages conditioned on severe austerity and structural reforms in the debtor countries. Public narratives often blamed fiscal irresponsibility and local mismanagement. Less attention was paid to the role of cross-border lending practices, the design flaws in the monetary union, By the time the world confronted the COVID-19 pandemic and its economic aftermath, the terrain of global debt had changed again, but the underlying logic had not. As revenues shrank and health expenditures soared, the burden of servicing external debts clashed with the immediate needs of their populations. Calls for comprehensive debt relief met with partial, hesitant responses. Some payments were rescheduled, some deferred. Yet the deeper question about the fairness and sustainability of a system in which entire societies could be thrown into crisis by the turn of a global financial cycle remained largely unaddressed. So what, then, is the legacy of the unknown cartel that orchestrated the first modern global debt crisis? It is an architecture, a way of organizing global finance that concentrates decision-making in the hands of a relatively small number of institutions, aligns their incentives to favor the continuity of debt-based expansion, and deploys a set of powerful narratives to justify both the boom and the inevitable bust. The architecture rests on a few recurring assumptions: that capital must be free to move where returns appear highest, that the costs of adjustment when things go wrong should be borne primarily by debtor societies rather than by the institutions that drove the cycle. These assumptions are rarely stated openly, but they guide the responses to crisis after crisis. The first global debt crisis revealed this pattern in its early, relatively crude form. For citizens watching from the outside, this can create a sense of inevitability, even fatalism. But the history of the first global debt crisis tells a different story. There are moments scattered through this history when alternatives briefly come into view: proposals for coordinated debtor action, demands for more symmetrical adjustment in which creditor countries would accept greater responsibility for correcting imbalances. More often, they are blunted, delayed, or absorbed into reforms that leave the main structure intact. That persistence is, in its own way, a measure of the cartel's success. It has managed, over decades, to shape not just the flow of capital, but the very language through which that flow is discussed. Words like stability, credibility, and reform have been draped over policies that systematically prioritize the preservation of creditor claims over other considerations. To question this hierarchy is to risk being labeled irresponsible or radical, even when the questions arise from the lived experiences of societies bearing the weight of repeated crises. Standing back from the details, a stark picture emerges: a world in which the lifeblood of modern economies, credit, is controlled by a structure that is only loosely accountable to democratic oversight. A world in which the fate of millions can turn on the decisions of a few central banks, a few large financial institutions, in the way responsibility for failure is displaced onto those with the least power to shape the rules. To see it requires stepping back from the immediate drama of each crisis and recognizing the continuity that links them. The story that began in that glass tower in New York in August 1982 is, in many ways, still unfolding. The contracts have changed, the acronyms have multiplied, and new players have entered the scene. But the fundamental question remains unresolved. Who should bear the cost when a system built on expanding debt runs up against the limits of what societies can sustainably pay? As long as that question is answered by default in favor of the same small circle of institutions, the architecture forged in the late 20th century will endure. On their screens may appear abstract, the risks may seem manageable, the contracts may look airtight, but history suggests that behind those numbers lie futures that will be shaped, for better or worse, by decisions made far away from the people who will live with their consequences. The first global debt crisis was the moment the mask briefly slipped, revealing the outline of a cartel that had taken shape without needing to call itself one. Whether the world chooses to learn from that revelation, or to allow the same architecture to generate the next, and the next, and the next crisis, remains one of the defining questions of our age.